I used to follow the debt-free fast crowd until I ran the numbers and realized I was throwing tens of thousands away. Today, I'm going to show you the strategy that lets you pay off your home smarter and faster, right? Car loans, student loans, and it's going to help you keep more cash in your pocket long term. Stick around because most people miss this one move that could save you years and thousands of dollars in interest. So you're going to want to stay till the very end. Let's dive in. All right, so as is the custom, we're going to be going over real numbers here. Thank you so much, Jaquan, for sharing your numbers so that we can help even more people get out of debt. We have loans, and the beautiful thing about this is there are a variety of loans. I mean, lenders love to see this type of person come in. Why? Because they have a mortgage, they've got credit cards, all right? They also have car loans as well as 401k loans. So we're going to get into this and share with you how you can get out of all of this, not in 30 years, not in 40 years, but in so much less time, okay? So let's go ahead and go over these numbers here, then we're going to get into it. So we have a mortgage at $308,000 at 6625, $2,776 a month on that mortgage, 12/6 at 7.9%. We're paying each month $265 a month, 4/8 at 29.24, right? That's $4,800 is the balance. We got $150 a month that we're paying on that, 4.75K at 0%. Then it's going to jump up to 29% after 18 months, $49 a month. We have 33K at 8.9% and then $715 each and every month on that loan, that car loan, and then 60.5K at 665% at $1,042 a month. Now, let's jump to the 401k loans. Now, these 401k loans, they're different because they're part of your 401k, aren't they? All right. $5,360 at 5.75, $499 a month on that one, $5,951 at 4.26, and you're going to be paying $263 each month on that one. Now, with any loan, what's really, really important, right? That we go over how we're going to pay it, right? Where is our income at? Now, we have the income of $8,540. We have expenses that are non-debt at $3,585. And then the debt payments are going to equal $5,760. That's going to leave us with a negative cash flow of $805. Now, I want you to know that I know what you're thinking. You're thinking, wait a minute, how are you supposed to pay off any of these loans fast with a negative cash flow? Well, that's where velocity banking comes in. And I want to share with you what Jaquan said. He said, CJ, I have been approved for $45,000 in a home equity line of credit. Now, watch this now. Just because it's a home equity line of credit, right, does not negate you. Just because it's these person's numbers, right? Maybe their numbers aren't your numbers, but you're going to want to pay attention to the principle I'm applying because you can apply the same principle to your numbers with your line of credit no matter what it is, okay? So in this person's case, they said, CJ, watch this. On Monday, I got 45K in lines of credit on my HELOC. Congratulations. What are we going to do with that 45K? We're not going to improve the house. We're not going to get another car. We're going to use this 45K to get rid of all of this so you can capture 100% of all this cash flow very quickly. Now, listen to what we're going to do. The first move we're going to make is we're going to take out each of those credit cards, right? What that's going to do is it's going to free up $464 in cash flow. Now, let's go ahead and add that $464 to this number right here. Remember, that's where we're at. And folks, when you're in a challenge like this, the first thing you want to do is stop the bleeding, and that is exactly what we're doing. So let's go ahead and add that together. What is that? Negative $341. Okay, now remember how you're going to pay this. How are you going to pay your home equity line of credit? What are we going to do? Remember, we're going to be paying with our income, all right? So let me share with you what that looks like, right? We've got $8,540 in income, right? We're going to go ahead and put that inside of our home equity line of credit, which $8,881 in expenses. Remember, we've got those expenses. And that's going to equal what? Negative $341 each month. Now, it's slow, isn't it? But we are not, and this is very important, we are not at negative $805. Why? Because we've increased our cash flow by paying off these cash flow sucking credit cards. All right? Did you guys get that? Now, even though we're $8,540, all right? Yes, we've got the expenses of $8,881. All right. Okay, we do. Negative $341 each and every month until we take what is in our home equity line of credit. Remember, we still have one. The $22,850. $22,850, and we are going to wipe out this car loan. We're going to wipe it out. Now, pop quiz. What happens, and I'm going to get out of your way, what happens when we wipe out the $33,000 at 8.9%? Well, we're going to capture that $715 a month. But you say, but CJ, you are still going to have a balance of $10,150. That's right. That's right. For about 12 to 18 months, you will still have a balance of $10,150. But then you're going to pay it off so that you're going to get out of that in about, let's just say 18 months, a year and a half. I just wanted you to jump ahead and notice what's waiting for you after that 18 months. Okay, $715 each and every month. Now, let's go ahead and let's back up and share with you why that's the case and why you would even want to deploy $22,850 towards this car loan. Let's go ahead and look at what we have in terms of 33K amortization table and in terms of the 10K $10,150 amortization table. Let's see what it looks like and see if you're really going to get out of that car loan as quickly as you thought you would using Velocity Banking. Is that okay? All right. So when you're looking at the $33,000, here's where you're at. You're going to be paying $244 towards interest, $471 towards the principal. While on the $10,000 one, guess what your interest is towards the bank? $80. And then the principal, $635. This is why you want to deploy it. You want to get out of the loan. The whole reason why is not necessarily so you can brag to your friends, even though you can do that, right? But it's so that you can capture that $715 a month and add that $715 a month after that year and a half to this number right here. I need you guys to see this, okay? Okay. What is negative $341, okay, plus $715? That's right, it's $374 positive cash flow. Now we can pay off our home equity line of credit. Now we are cooking with grease. We're cooking with lards. We're cooking chitlins. All right. Now, this is what we're going to do with the $374. We're going to take a step back here and we're going to make the decision on whether or not to pay this off, right? Or our 401k off. Now, remember what you can do in order to see or to prioritize which loan you're going to pay off first. You can place it through what's called the cash flow index method, right? What is that? Well, that's where you have your line of balance and you're going to divide it by the minimum monthly payment. That's going to give you a number between 0 to 100. Anything that's 100 and above, like some mortgages, this mortgage is 100 and above, so you don't really have to worry about that. Okay, Jaquan? Or if it's between 0 to 50, that's the danger zone and you need to get rid of that very, very quickly. And 51 to 99, well, then you can restructure, you can refinance, you can ask for a lower interest rate. There's so many things you can do when you are 51 to 99 on that cash flow indicator. So all you need to do is place your balance, divide it by the minimum monthly payment. It's going to give you a number, do accordingly. All right. In this example, we're going to go ahead and take out the 401k loan. Has the 499 because these are 10s and these are 22s when it comes to the cash flow index. We want to get rid of that cash flow sucking loan right now, okay? And I know it's the 401k, right? So it is a different categorization of loans, but it's still taking your cash flow. So let's go ahead and grab that cash flow for us, okay? And when you are out of this car loan, because you're going to be paying it the same way that you paid all these loans, you're going to focus on the principal, not necessarily the interest, so that you can get this $1,042. All right. So once you are out of this car loan, the 401k loans, then you can be concerned with the mortgage, right? Now, you don't have to be, right? But it is sucking the $2,776 a month. Can you better handle that $2,776 a month than the bank can? I think you can, all right? And so let's just go ahead and run down what this looks like, all right? Those credit cards were done. This is what we just did. Those credit cards are done in a month. All right, with one swipe of the $22,150. All right. The car loan one was done in about 12 to 18 months. Okay. Car loan two with the 401k, all right, right there, done in about 3 to 4 years. All right. And what else do we have? If we add up all of this, the 265, the 150, the 49, 715, 1,042, right? 499, 263, right? Let's go ahead and add it up. 374, 1,042, 499, 263. Okay, it's going to equal $2,178 each and every month. Let's go ahead and just point to your new cash flow number. But remember what you must do. You got to focus on the principal. All right? Focus on that principal, guys. Focus on the principal. That's where we're doing. That's how we're getting rid of even mortgages. And I know you've heard it said, oh, don't worry about your mortgage, right? And you don't have to worry about it. It's not a cash flow sucking loan, especially in terms of what you get, right? But now you don't have to stay in it for 30 years, for 40 years. They have 40-year mortgages now. Now you can get rid of it in 7 years. 30 is the new 7. I want you to go ahead and comment that. 30 is the new 7. So what would you do with an extra $2,178 a month? What would you do with it? May I suggest that you invest in assets that give you more cash flow, right? I think you can. So let's go ahead and get out of the way so you can get a picture of your future, especially Jaquan. This is your future, Jaquan, if you so choose. Now you can use the $45,000 to renovate your house and spend it on all sorts of consumables, or you can use it in one of the most wisest way possibles, and that is to create for you $2,178 a month. What would your spouse rather have? A renovated house or an extra $2,178 a month? I tell you, when you make enough of that, you can renovate the house and you won't need a line of credit. If you are looking to increase your cash flow and erase your debt, go ahead and Get this video right now, punch on it right now, and hit that like button. We're gonna get this all throughout the world. Everyone needs to know the power of velocity banking. God bless you, and you have a great night.